This last year, every Tom, Dawood and Harvinder has been making an absolute killing on the stock market, and they've been telling you about it. And so as a result, you're thinking, hang on, maybe I should get started on investing. But there's a big problem. You don't really know where to get started. Well, worry no more. This is the video for you. This year, I've been entrusted $25,000 by my parents to invest for them. And I'll be sharing blow by blow how I approach research and how I approach investing. I'll be sharing with you the good and the bad and the ugly, but hopefully there won't be no ugly because we'll make some profits. And don't worry folks, I'm not a complete tool. I have been investing for over a decade and been profitable throughout that period. And for more information about me, you can find out in the About Us link in the description below. In this video, I'll be sharing with you 4 things about investing in stocks and shares. Firstly, what are the things that you need to do initially before you even start thinking about researching stocks? Secondly, I'll share with you my 4 high-level investment theses, my view of the world and where it's going to head to in the next year. Thirdly, I'll share with you how to run a simple stock screen and talk you through the mechanics of that. And finally, I'll share with you how to actually look over initially a stock that your research has pointed you to and the kind of things that I look at as I go through that as well. If you're new to this channel, Islamic Finance Guru, or IFG for short, is a halal investing and personal finance community that reviews, analyzes and compares all the different investment products that are coming out of the Islamic finance and investment world. Our mission is to help Muslims and minority communities globally get wealthier and make their money do the work for them. If that sounds like it's up your street, then please do hit the like button very delicately and then just nicely stroke the subscribe button to make sure that you're in the loop with all the ups and downs and the ongoing shenanigans that we get up to. And please do feel free to share any of these videos with your family and friends. This is completely allowed. If you'd like to chat with me or hang out with a whole bunch of other like-minded investment people, then please do join our Telegram group. The links are in the description below. They are super helpful and you get to learn all sorts of weird and wonderful things. Plus, I will share with you my research notes for each of the stocks that I pick during the course of this year. So please do join. So the background to this whole 25K was, as I explained in my previous video, I was looking after my mother-in-law's portfolio and I made 108% return over 4 years. When my dad found out about this, he was like, what on earth? Why didn't you tell us? Why didn't you make this money for us? To which I responded to him, well, you didn't give me any money to do that with. To which he responded, here's 25,000, go away and do that. So that's what I'm up to now. So my dad is, alhamdulillah, near retirement now. He's a doctor, so he's financially stable, alhamdulillah. £25,000 for him is an important sum though still. It's not something that if it just went to zero, he wouldn't feel that loss at all. He would feel that loss. And so I can't take the same approach that I did with my mother-in-law's portfolio, which was just £3,000 and she said, do what you like with it. For with £25,000, I need to be a little bit more responsible, but still quite high growth minded because that's the mandate that my dad has given to me. Make this money go up quite quickly. So the approach that I will be taking here is I'll be running a fairly concentrated portfolio, not just like 4 to 6 stocks like in my mother-in-law's portfolio, but more like 10 to 15 stocks because I wanted to be a little bit more stable. I'll be focusing mainly on UK and US stocks because that's where I feel that I know things the best, but also it makes it easier to research when the language of the companies that you're researching is English, so you can actually access it, and that's super important. And I'll be looking to invest probably with a 3 to 10 year time horizon, so fairly long-term investing. And I'll be looking to primarily go for growth stocks, so companies that don't necessarily give dividends. However, if something obscene comes up, like if someone is just giving me ridiculous amounts of dividend yield and it's a great company, then I might just get tempted and do a little bit of that as well. I will look to slowly deploy this £25,000 over the course of, I'd say, the next 3 months or so. It might go quicker, it might take a little bit more time. I'm in no rush. The key thing for me is to make sure that I'm really high conviction on any stocks that I put my money into. I have 4 high-level investment theses that I'm going to explore as part of my research. And the reason why you want to have theses like this is because it gives you a perspective to see the world and to try and explore if there could be some kind of hidden opportunity here that perhaps the wider market has missed out on. And so here are my 4 theses. So the first way that I'm going to approach my research is just the classic value-based investing, looking for something that is growing nicely year on year, that has a really good set of financial accounts, that has no or little debt, that has income growing, that is in a growth sector, that it will have a low price to earnings ratio, which is a nice ratio that tells you that the stock is relatively cheap relative to what it's earning. And also I look at the stock chart and see that that all kind of checks out as well. So think of it like the Warren Buffett or Benjamin Graham kind of school of investing, of looking for value and growth over a long period of time. So as part of my other work that I do, I'm a partner at IFG.VC, which is an angel syndicate that invests in early stage technology startups. So I know a fair bit about technology, and we invest early stage there. But the thesis I have for the public markets, which are much larger companies, is that you have companies like Amazon and Twilio and a few others who have these very large monopolistic kind of characteristics, and they're just churning money now. They're just printing money, and they have a very dominant space in the market, and it's very hard to compete against them. So I'll be looking to pick off a few of these as well. And these companies will be more expensive than others because, of course, the market respects a monopoly. But the thing that I found is that typically monopolies, even when they look expensive, because they're monopolies, they continue just growing and growing and growing over time. So I'll probably be looking for a few of those as well to add to my portfolio. The other thesis I have here is that I like the technology sector. I think that the margins when you're using technology become really, really big, and that's a good place to invest your money. However, the majority of technology companies are in the US, and the US market is very hot, and a lot of people invest in the US market. So I think that there are a whole bunch of technology companies potentially in the UK and listed in the UK market that aren't priced as aggressively as the US market is, just because there's less attention given to the UK market. But the thing is, technology companies, it's a global platform, right? They are not going to be restricted even if they're listed in the UK or based in the UK. They can access the global market just like US companies. That means that there may well be a little bit of a price differential, and you could find some cheap technology stocks in the UK. That's a thesis. I'm going to explore that and find out. And then finally, I'm going to take a few speculative positions on some smaller companies that have a market cap of less than 50 million, perhaps even smaller than that, 25 or 10 million, and just, punt a few things and see what happens. I'll be typically looking to invest smaller chunks into these companies. So instead of doing, let's say, 2,500 into a company that I would do on average, I'd probably do something like 1,000 or perhaps even 500. And if it goes well, great. If it doesn't, then it's not a massive loss. Let me run a stock screen for you. I'll be using a Warren Buffett preset screen on the FT because I think it's a nice screen to talk through, because it covers a lot of the important stuff that you guys need to know when you're doing this. Let's dive in. So here's the Financial Times Equity Stock Screener. It is a paid service, but it's pretty good. They've got these predefined screens that you can use. So I'm just going to use the Warren Buffett screen, but they've got a whole bunch of other screens as well that you can explore. And you can come up with your own screens and then save them as well. So let's have a look at what our man Warren Buffett has come up with. I've actually tweaked this and I've put the country down. So there's only 2 countries, USA and UK covered. And that actually meant that the total number of results reduced from 100 to just 20, which is quite a nice number to then actually dig into from a research perspective. Now, Warren Buffett, he doesn't like companies that are too small, which is fair enough because small companies are a bit more volatile. And so he set this 25 million mark. He likes companies with a decent profit margin and a profit margin of at least 15%. This is pretty interesting, and I think that's a good way of thinking about it, because the higher profit margin companies are generally more versatile, they endure better during downturns, and they have more cash that they can mess around with and grow as well. So companies like Google, from memory, are like 80-85% profit margin. That is massive, and that means that they just have a ton of cash that they can use to grow and invest and deploy elsewhere, which means that they continue growing and adding value to their shareholders. So that's why profit margin is important. Then you've got the profit margin 5-year average, and Warren Buffett has set that to 20 as a minimum. And that's interesting because I think he wants it to be growing over time, and you would expect that to happen over a 5-year period. Earnings per share growth, he wants that to be at least 5% over the 5 years. And the thinking here is that the earnings per share are growing, right? That is a good thing. It's unequivocally a good thing. If your earnings per share are growing, that means that your earnings are growing, and it's actually relatively cheap as a company if the earnings per share are growing, and you know that there's going to be more growth in the future. So Warren Buffett has set the price to earnings ratio as a minimum of 3. What that means is any price to earnings ratios below that are typically because of some random financial statistic or some anomaly. He's just getting rid of the noise. And then you've got price to cash flow, which is a good number to have, and he set that at a maximum of 8. What that means is he doesn't want to be buying expensive companies. If the cash flow is more than 8 times the price, that means that the company is probably too expensive for Warren. And then you've got the price to book value, and again he set that at a maximum of 4. Price to book value is where, think of it like a company just liquidates absolutely everything and sells all of its stock and all the assets that it has. That's the book value, right? And Warren Buffett doesn't want to be paying more than 4 times that book value. People do pay, obviously there is a multiple on the book value normally in stocks and shares because companies are, they have the future potential priced into their stock price. But Warren doesn't want to pay more than 4 times. And then he has a return on investment over 5 years of at least 15%, seems decent, and an interest cover of at least 2 as well. So he wants to make sure that you are financially very stable and actually can cover any debt payments that you have going in the future as well. A really interesting stock screen, and it chucks up about 20 different companies, and a whole bunch of these look really interesting, and let's dive into some of those now. So here I'm going to look at 4 of the companies that the screen chucked up. I'm not going to do a detailed dive into them, but what I want to give you here is a look at how I think about companies initially when I'm just looking at them from an initial screen perspective. So the first one is CMC Markets PLC, which has been thrown up. And I'm thinking CMC Markets, I think it's a Forex trader of some kind. And sure enough, I go into the profile, and CMC Markets has Forex trading going on, and it has trading platforms, and it does various different things, including CFDs and financial spread bets as well, and binaries. Now, from an Islamic perspective, that's just a no-no. This is probably the point when I would just stop looking at this company because I know it's just not going to be acceptable, and I'll just switch off from it. So let me close that down. Ferexpo is another company. I don't know what it does. I'm guessing it's something to do with iron because it's got Ferex in its name. Yep, it's an iron ore pellet producer, and it's got decent income. It's based in Switzerland. It seems to be, basically a producer of iron ore. So I'm thinking, okay, it's going to be exposed to production and China and just wider macro trends as well, as opposed to just the sweat of its own labor. It will be affected by wider macro things. Now, if I look at the next thing I look at is the financials. I like to see revenue growing year on year. That looks like a beautiful revenue growth. I like to see income generally positive. Cash flows are pretty tight. That's interesting. So I'm now looking at the debt to make sure that the debt is below. I mean, the debt has been reducing, which is a good sign. It might go up this year because of COVID. The total debt to equity is 26%, which is good, and it's just under the 33% debt to equity or debt to assets that is allowed by the Sharia. Now, I wouldn't just rely on this initial number. I would actually go in and do the screen itself, and there's another video we've done where we share how to do that. But this is a good check-in point. The dividends per share have been growing. That's good. The earnings per share have been, broadly speaking, growing as well. The dividend it gives is, it's not amazing, but it's a decent dividend that it's giving out. So this is going to be a company that I probably will put into my shortlist to look at the annual returns and then also to look at the news around it as well. And on this, on the FT, you actually can find some news. So I might actually open these up and read them afterwards, just to get an initial sense of what's the talk on the market that the FT is giving. And then I might look at the stock price here as well in the corner, and I'll look at it at the 3-year and 5-year levels, and just to see what the stock market has been doing overall for it. So it looks like there's been 3 historic peaks, and currently it's kind of operating at a peak, which is not ideal because you typically want to be buying a company like this when it's a little bit cheaper. So it might become one of those where I put it onto the to watch pile, but wait until it comes down a little bit. But then that could be a wait of about 6 months. So anyway, that's kind of a really hot take on how I would approach this kind of stock. Let's look at Akatsuki, which is a random stock that was chucked up in the screen. And I think I got rid of it in my latest screen because I went for UK and US only, but in the initial screen it came up, and it's a Japanese company, and it's a very interesting Japanese company. It's in the mobile game business and live experience business, and let's just open up its website and take a look at the website. And the website is hilarious. Like a lot of these Japanese companies, for us, obviously it's hilarious. For them, it's brilliant. They're making millions and millions of pounds. They're a $1 billion company. And if you look at it, and I'm thinking, oh my God, this is really weird. It's like they're doing these kind of cartoons for their Japanese audience. Already I'm thinking, I'm not sure I'm comfortable enough to know enough about Japan and this market to be able to do this research, and B, there might be some kind of Sharia compliance issues in terms of the appropriateness of the cartoons. The financials are pretty solid and they're growing nicely. The debt is pretty in control as well. So it probably isn't one that I will look at just because of the things that I said, but it's an interesting one to talk through regardless. The final one that I want to talk through is Biogen. This is probably a medtech company. Yeah, it's a biopharmaceutical company, and they discover, develop and manufacture and deliver therapies around neurological and autoimmune diseases. Very interesting. It's got a basket of different products already, and I presume that it's developing more products as it goes along. It's got net income of $5 billion, and it's got revenues of 14.26 billion, which is decent, right? That's a decent margin as well. I'd love to see the financials on this and see how they're looking. Again, beautiful revenue graph. Like, this is what I would expect from a Warren Buffett screen. Really nice revenue growth. Income is looking pretty good as well. Cash flows are looking solid. Cash is increasing as well, and that's really, really solid. And the debt levels, the debt levels are quite high here. So it's 70% and 40%. So this is not exactly the Sharia compliance screen. So that is total debt divided by total assets, and here it's they're dividing by capital and equity. So it's not exactly the same thing, but it looks like this company could well trigger the Sharia compliance issue. So it's not going to be a write-off right at this stage. It will be something that I would look into if I think that this is a company that I definitely want to go for. And I'll continue looking through the screen. Like, look, this stock market graph suggests that it's at a relatively low point over the last 5 years. So that makes me excited because I like to buy things cheaply. And I know that the broad forecast for pharmaceutical companies is generally positive, given that COVID has boosted the pharmaceutical sector, but also because COVID will cause a whole range of other illnesses and ailments which will make the pharmaceutical companies do better. So I'm just thinking that in the back of my head. Warren Buffett apparently, in the news, it says he's pulled back on banks and bets on drug makers as the future, which is very interesting. And I suspect this is one of the companies that he's invested in. So all of this is very fascinating. The key thing for me here will be to go away and look at their financial accounts and look at if they are actually Sharia compliant or not. I hope that's been helpful. So from all of that analysis, what I'll probably do is run a few more stock screens and tweak things up and get a bit of a sense, and probably shortlist maybe something like 20 companies then do a bit more of a deeper dive on a few of them and come up with maybe like 5 target companies that these are actually something that I would potentially want to buy. And then I start tracking them. And some of them are cheap right now. I'd probably buy them right now. Some of them are not cheap right now, but I just keep them on my radar to enter the market at the right time when the price is cheap. So that's it for today, folks. That's a really snapshot way of looking at how to research stocks and come up with some investment ideas. I will be sharing some detailed analysis on individual stocks as well in the videos to come. So please do subscribe to this channel and like this video. And please do also join the Telegram group where I'll be sharing the detailed research notes that I do for my stock picks as well. Until next time, Assalamu alaikum.